Right. Here's the simple version of what I see going on at the moment. This is what I do. Like as I said in a video I did, just the last one. I've taken off most of what I've got, so it's back to square one, looking for where I think the next compelling trades are. And I'll go back to these area charts because they're quite. I just find them very helpful in clarifying, what has happened and what hasn't happened. I guess that's one way of looking at it. And the RSI, that's pretty much the only technical indicator that I really pay attention to. Apart from Bollinger Bands, the Bollingers on big moves, I find quite helpful working out when something is really, really compelling. As an ex-options trader, I still trade options, but institutional options like running the risk, interest rate options, caps, collars, floors, swaptions, bond options, digitals, barriers, average rate options, all the exotics, also in currency options as well as interest rate options, a bit of commodity options, some equity options as well. Given that's my background, the Bollingers and the standard deviations away from the mean, I pay a lot of attention to. Anyway, having said that, that's the complex bit. Here's the simple bit. 2009 long-term trend, just touching it on the downside. That was a target. This could still make it, on the wide, like have another line down there, right? But let's face it, that was the COVID event. This was the GFC. For us to dip down here, we're going to need a serious trigger, not just the Fed raising, a serious trigger. So that's one, the trend line. Another one is, you can see here is on that 38 retracement. That's a second one. Third one is it's obviously come down on the monthly RSIs and on the weekly RSIs. It's just hitting oversold. And then the other one is in here, which is that gap. You can see here, the lines are good, right? Because they kind of exaggerate, they clear out some of the noise. They kind of exaggerate the moves that are happening. So you can see here the wicks there, they kind of get wiped out when you look at it just with the lines. But you can see here how it is filled. That gap there, like all this, there's a lot of overlapping action in here, and then it just went shot right through there. That was around about 4,000 big psychological barrel, never came back. It's come back now. So in a lot of measures, it's done the hard work and will take a shock to get down there. That's the S&P. Let's look at the Russell. Again, simplicity matters. Monthly, big trend, previous high, 50% retracement. There it is, coming off the overbought, and on a weekly, it is oversold. Right. Feel that big gap there. The Dow tells the same story, so they're all saying the same thing. Big long-term trend since GFC. Here, this has had a more shallow retracement, like 38.2. It's come back to that trend line, and it's filled in a roll over that gap. See that last high, low, shot through, and it's just come down and it's testing that there, coming off the oversolds. That's the Dow. The Nasdaq, same story. They're different retracement levels, right? But they're still there. Long-term trend hasn't come back yet. 50% retracement from that move. Obviously, from this move, it'll be a deeper retracement. That's probably like a 78, I'd say. Ha! Here we go. That was just a guess. That's the 78 retracement. So it's, it's certainly retraced a lot of that big move. Still has some more to go potentially. But again, you can see even here, that was COVID, took it to the bottom of this channel. It will need a bit of a shock, bit more of a shock to get down to that level. So that's the Nasdaq. These are all monthly, right? So they're big time frames. 10-year bonds, logarithmic. I generally look at these like in a linear way, right? But I can see particularly these long-term moves when there's extreme price moves on anything. I guess and interest rates does fall out battery wide. There's an argument to look at a logarithmic scale. In any case, wherever you draw the trend line, it's come back to this outright level. That's a good 1 to 1.6 retracement or extension up there. You can see how it's nicked in there just on the candles, and has certainly come back to this previous line of bit of support and resistance. It overbought on the monthly. The 2 years, same story, right? Hit a key level. Again, whether you draw a logarithmic or on a linear basis, it doesn't really matter, because in any case, it has hit this level in here. And it's filled in that massive gap where it rolled over, heavily overbought. So, there the markets have made most of the cash from, and, as you can see, they're all telling the same story. It's all really simple stuff. Long-term trend has been returned to. Decent Fibonacci retracements to some good technical levels. Rolling off overbought, oversold into the weekly. As I said, there's no rocket science, right? The ones that I still have open, I'm looking for gold. This is back from 2009-10. Went up, past the parcel, broke back down, went up, past the parcel. I think it's going to break back down to $1,400. The Aussie won't really go in. Well, I'm here, might as well now. 1, 2, 3, 4, 5 waves down. 1, 2, 3 waves back up that I expect. Look at this on a weekly, and you'll see kind of why I've drawn some of these lines where I have. 80 to 90 cents to me is a very compelling level for it to go to, and you can see there's this big gap in there that I'm very confident it will retrace. Bull flag. So for me, the macro thematic in all of this is that the yields have done their work. Right? They might stay there, but really the longer term yields have moved, and now it's up to the Fed to meet those expectations. Those expectations are pretty high as far as rates go. And if the Fed doesn't meet them, right, then of course the bonds will come off and equity markets will probably rally on the back of that, pending that there's no, a caveat being that there's no shock. And as risk comes back on, that's going to be good for the Aussie, particularly where commodity prices are at the moment. At the moment, that is the big caveat. As far as the potential shock, of course, shitcoin is on my list up there number 1, along with combined Turkey and Russian sovereign default. Bitcoin is very delicately poised at the moment. You can see when it's come off a monthly overbought back here. It's 87% here because I've taken into account these the extremities here. Overbought here, came down 80. It'll be down here. 84%. Overbought here. Where's it going to go, boys? Let's measure down to here. 82%. Previous breakout, filling that gap. Look at that massive gap in there. That's like screaming out to come back. And you can see it's very delicately poised on some pretty important touch points on that trend line. It would not take much at all for this to tank. This is $1 trillion kind of proposition. This is the main crypto. If it goes down 82%, that to me would cause a washout in the equity markets. That is the number one thing that I'm looking for at the moment. There's a couple other little random things. Copper, Dr. Copper as they call it, doesn't really get talked about that much anymore. But to me, it's in danger of rolling over. Up past the parcel, it could well and truly roll over. You know, and I guess to me, part of this macro thing is inflation is out of control, right? It's not out of control because of where the Fed has dropped rates to. It's out of control because of a lot of supply issues, really. And I think that low rates aren't going to bring down the copper price, right? And other commodities. They're going to come down of their own volition, I think, because they will eat away because they're themselves, because they're just not that sustainable. Tin is another little bit of a weird one, but it's already started to roll over, right? You see that it happens pretty quickly. I haven't looked at wheat lately. Let's have a look at wheat while I'm here. See what's going on. Yeah, well, look at that, hey. This vertical action only ever ends in one way, right? And it ends with basically a big retracement of that. I'm not quite sure what's happened there. A big retracement of what went on in there. That'll come back. Yeah, so I wouldn't be surprised. I guess my macro thing that I'm playing is I think a lot of these commodity prices are going to correct of their own volition. The Fed isn't going to need to raise rates as much as the market expects. So bonds will stay where they are, and then they'll come back. Like yields will drop, bonds will come back. Particularly at the short end, the curve will steepen. I've got a bit of a steepener on. Unless there is a big Bitcoin shock, then I think we're in just for a bit of a bumbling round with equities, actually. There is still risk to the downside, though, but I wouldn't be. I'm not an aggressive. Well, I'm not shorting at the moment, but I wouldn't be an aggressive shorter. If it does tank, then I'll look to buy them up. Otherwise, I'm just happy to sit out. Look, that's pretty much it. I hope that's the simplest little technical analysis and macro analysis I can share with you. All right, have a good one. Ciao.